Bond yields continued to hedge higher over the recent weeks on the back of stronger economic data and higher inflationary pressures. The rise in bond yields was more pronounced in Europe than in the US, and this has contributed to the appreciation of the euro versus the dollar, which has been a significant factor explaining the performance of hedge funds. This has proved supportive for US risk assets. The S&P is up more than 2.5% year to date, while European and Japanese risk assets suffered on the back of the appreciation of their currencies against the US dollar. With regards to hedge fund performance, CTA and Macro managers underperformed in January, while fixed income arbitrage and event-driven managers outperformed during the same period. CTA and Macro managers were particularly negatively impacted by the appreciation of the euro against the USD to the extent that they maintained short positions on the common currency, while some macro managers were also impacted by the underperformance of European equities versus US equities. On a positive note, fixed income arbitrage, long-short credit and event-driven outperformed. They have been both supported by alpha and beta components. Long-short credit funds were supported by the tightening of credit spreads, in particular in the high-yield space, both in Europe and the US, while fixed income arbitrage has been supported by some arbitrage opportunities, such as the deviation between cash and future bond prices, which is typical when bond yields rise. Going forward, we remain constructive on fixed income arbitrage. This is a strategy on which we have a strong conviction for the rest of the year. We think that the rise in bond yields is due to continue. We think that treasury yields, the 10-year, should reach 3% by the end of 2017, and fixed income arbitrage is typically a strategy that performs well when bond yields rise. And while we are cautious on directional credit managers, we think that relative value players in the credit space should also perform well in 2017 in a context where the higher economic prospect should be supportive for some particular strategies. Finally, event-driven is also a strategy on which we have constructive views for 2017. Recently, the outperformance of the strategy was related to the planned merger between Actelion and Johnson & Johnson, a $30 billion USD deal, which ranks well in event-driven portfolios. Going forward, we think that the tax reform considered by the new US administration should be supportive for both the technology and healthcare sector, two significant exposures for event-driven managers that sit at the forefront to benefit from these developments.